Next, let's have a look at what I would call 3 critical measures here for your portfolio management simulations. First of all, the net future value. That's just the final account balance at the very end when you're ready to retire, end of your portfolio. That does take into account all of your inflows, so all the deposits, all the withdrawals, and it does take into account all of the interest earned. If you remember, our account balance always added in our previous account balance plus our current interest plus our current deposit. Okay, and so that's just our net future value. It's just that final account balance. No need to do a fancy Excel formula. You just grab the final balance for that one. The internal rate of return, that's your average yearly rate of return on your portfolio. Quite nice to have a look at this and compare it to other returns you could earn. Just use Excel's IRR call on that one. So it's just the IRR of all the deposits or withdrawals. And if the IRR is greater than your desired rate of return, again, do this after many, many runs of the simulation. So we'll look at doing a data table later here and looking at many runs. And if that overall average IRR is greater than your desired rate, then to the best of our knowledge, it's a good idea to invest in this manner. One last measure here, and then we'll do these all in Excel, the net present value. So this will be the profit or return in today's dollars of this investment. Use Excel's PV call, so not the net present value call, not the NPV, but the PV. Again, this one's a little bit different because our rates fluctuate every year. And do the following PV call. PV equals to the rate, comma n, comma 0, comma negative net future value, where the rate is the desired or most probable rate of return that the market's going to yield or what you would like to yield, have yielded. N is your number of years you're investing the money for. And that net future value, we already got that before, that's that ending account balance. We put in a negative to keep the same sign as our net future value was before, otherwise Excel will change the sign of it. Again, it has to do with those inflows, outflows. And if NFV is positive, then NPV will be positive, and if they're both positive, then to the best of our knowledge, it is a good idea to invest in this manner, however we're investing for this portfolio. Okay, and let's have a look at this in Excel now. So in Excel, the net future value is really basic. Just go grab that ending account balance. Not the cash flow, but the balance. Okay. For the IRR, just do an IRR call and grab all of the cash flows, the inflows and outflows. So not including, so don't grab the balances because those include this interest each year. We don't want to look at the interest each year within the IRR call. We want Excel to give us the average rate of return with just take into account all of the money we deposited and the amount we're going to withdraw at the end. And of course, it will account for that number of years. And finally, your net present value, just do a PV call. Grab your rate. I'm going to put it at 5%. I think I could earn 5% in some sort of secure investment otherwise. Number of periods is 30 years. Nothing for payment. There are payments every year, but they're very complicated. It's not one fixed value. So we account for them within our whole simulation table here instead. And the future value will be this net future value. Again, make it negative so that it matches in sign here to the, so the NPV and the NFV match in sign. And there we go. And in the next video, we'll look at recreating this scenario here many, many times and getting your averages based off of that to get a better, more accurate view of what is going to happen with your portfolio.